During the extended bull market that followed the 2008-2009 recession, most stock pickers focused on growth investing. This emphasis shifted dramatically in 2022, as markets fell and investors dumped shares in growth-oriented companies. For some growth stocks, the tide appears to have turned. This is an excellent time to examine what works for growth investing strategies and the potential limitations. Value versus growth. Many investors consider value investing to be the polar opposite of growth investing. These are distinct investing styles, but I would argue that all growth investing is ultimately value investing. The difference is that the value is calculated using future value rather than current value. This focus on the future is what makes growth investing both appealing and challenging. The appeal is that future growth has the potential to outperform any other type of gain. Early investors in companies like Facebook, Amazon, and Telsa are good examples of this. The problem is that the future is, by definition, unknown. As a result, any lofty forecast for the future could run into a brick wall of unexpected problems. How to be successful in growth investing. To be successful in growth investing, you must select companies that will be winners in the future. Here are a few methods for increasing your chances of spotting future giants. The correct trend. I purposefully used the word trend rather than technology. A trend could be a specific technology, such as smartphones, electric vehicles, or semiconductors. It could also be the growing popularity of large supermarkets. Walmart was once a small company experiencing rapid growth. Starbucks was a small coffee shop that sold expensive drinks. The key here is to identify a powerful economic trend, usually something that people are willing to throw money at. This does not have to be about technology. The ideal target is a broad industry that is expanding rapidly and has easy access to capital. This means that the companies you select can grow both in market share and in tandem with the sector as a whole. Distinctive advantage. Once a good trend is identified, you must identify a company within it that has a clear competitive advantage. This advantage can be unique technology, but it can also be a better business model and economies of scale. Walmart, Costco, an oligopoly or monopoly, Visa and MasterCard, or exceptional customer service, Starbucks. The point is that we already know the sector is rapidly expanding. In that case, the company with a difficult-to-replicate advantage will almost certainly win the competitive race. This results in a phenomenon known as the flywheel effect. The more it grows, the stronger its unique advantage becomes, the more of the sector it dominates, and the faster it grows. Repeat as necessary. Develop expertise. Because explosive growth is usually accompanied by dramatic changes and disruptions, it can be difficult to comprehend what is going on. Investors who develop a true expert view of the industries in which they are most interested have a significant advantage. This can be a one-of-a-kind insight into the technology or a thorough understanding of the business models of the innovators driving the growth. Being or becoming an expert will give investors an advantage over generalists, who frequently overlook factors that can disrupt the industry and render previous financial models obsolete. Price is still important. Growth investors are a cheerful bunch. They are not afraid of the future, rather, they eagerly await it. This positive attitude can lead him astray. It is common for growth stocks to be valued higher than more stable companies. This makes sense, because cash flows growing at a rate of 20%–30% per year should be factored into company valuation. This is not to say that any price is appropriate for growth stocks. A valuation that is overly optimistic can lead to a bubble, especially if the valuation is based on hype and unrealistic expectations. This is the most legitimate criticism leveled at growth investing. The best example was during the dot-com bubble, when some large company stocks, rather than startups, reached absurdly high valuations. Any company trading at more than 10 times its revenue is most likely grossly overvalued. The same is true for any stock with a P/E ratio greater than 100 or a price-to-free cash flow ratio greater than 50. This isn't a new or technological phenomenon. In the 1970s, the Nifty 50 stocks were similarly overpriced, with subsequent declines of up to 90%. I'll also point out that it's not about the company's quality. McDonald's and Disney were great growth companies in the Nifty 50. However, at the prices they were trading at the time, they were poor investments. The problem is that, if everything goes well, the company's sales could be multiplied by 10 in a decade before slowing down, which would be exceptional. The company's current valuation already accounts for such lofty expectations, with a price-to-sales ratio of 10. Anything less can result in a disastrous crash. and success would imply no capital gain. In this case, the risk-reward ratio is abysmal. I suspect that some of this era's high flyers, such as Tesla, Moderna, or Nvidia, are in the same boat. You can believe in Tesla while also recognizing that it is too expensive to be a good stock pick. Putting together a growth portfolio. It is unusual for only one sector of the economy to be expanding. Could you, for example, guess which US stock produced the highest returns from 1990 to 1998? Given that this was the time of the dot-com bubble, you might expect some tech stock from the time, such as Microsoft. Veritas, a Houston-based oil service company, had an astonishing 146% annualized return. Every year, 1.5 times, 12 times in 8 years. Growth investors should avoid becoming overly focused on a single industry or technology. The future is extremely difficult to predict. Even the best growth investor in the world will make mistakes from time to time. Diversifying both individual stock picks and sectors will be critical for risk reduction. The winners of the 1990s were not only in technology, but also in oil, biotechnology, retail, and finance. Diversification is also important for increasing returns. Only a few stock picks can produce exceptional results in growth investing. This means that less than 5%, 10% of the portfolio's total returns are frequently driving total returns. Many successful investors over the last 20 years will have made the majority of their money from a few positions, such as Nvidia, Amazon, Tesla, or Bitcoin. These were risky bets at the time. Almost no one placed high hopes in a low-margin computer card manufacturer, a loss-making bookstore, a manufacturer of self-igniting sports cars, or obscure lines of code with no discernible purpose. Conclusion. Growth investing can be a highly profitable strategy. It is also ideal for tech enthusiasts and people who are naturally optimistic and think outside the box. Returns in a growth portfolio are most likely to come from moonshots if the portfolio is sufficiently diversified. For growth investors, high concentration is likely to lead to disaster. In contrast to value investing, there is no margin of safety to rely on here. Another thing to watch out for is inflated valuation. It's easy to believe that the stock that just did X20 will soon do another X10. Instant millionaires may believe they are geniuses, ignoring the role of chance. The exponential curve always comes to an end. As a result, successful growth investors may benefit from knowing when to take profits, and to never associate their identity with their stock picks. Don't forget to subscribe and like this video. Thanks.